But if we are talking strictly about these type of developments, what I always do when I have few imbalance points, all right, hope all of you guys are doing well. So in this video, as you saw in the title, we will talk more about imbalances and fair value gaps. And in this one, I strictly wanted to pinpoint a couple major signs that will help you spot fair value gaps that work better. Because pretty often I get questions, which fair value gap I should choose, which fair value gap is a high probability, and so on. So there are many outside factors regarding this, because when we have just a straight line, just price dropping, let's say to the downside, and leaving many imbalance candles, one development is not equal to another development. There could be 100 different scenarios of how, let's say, this expansion right here on the left goes from point A right here to point B right here, meaning that in this whole development from point A to point B, we could see many different situations happen. Price can melt in a couple sell-side imbalance, buy-side inefficiency candles, and a couple SIBI candles. Sometimes it can be literally just scrolling, leaving low resistance buy-side liquidity signs. Sometimes it can leave high probability PD raise. Sometimes it can move in a clear or the flow lag. Let's say in this case, notice that price rejected this fair value gap right here. Then it gave another fair value gap rejection right here. So in this specific situation, you can see that price was dropping lower towards point B right here, but it wasn't giving deep pullbacks. So what I'm trying to say is that from point A to point B, in some other case, we could easily see price giving deeper pullbacks towards the point B right here. So what I'm trying to say is that every single situation is slightly unique. There are many different variations that can take place. Those traders who try to force or squeeze a frame onto price action often end up just forcing something, forcing a position, forcing a view, forcing a drawn liquidity that's not even there, trying to trust a PDA that's not high probability, and so on. So this is why it's really important to just be aware of what's taking place, completely remove all drawings that you have on your charts, and just be 100% honest with yourself if something's actually taking place, or if you just simply want it to take place to be able to take a position. Because let's say you've been sitting on sidelines, not seeing any clear opportunities for quite some time, and you are just feeling anxious to take a position and to be in a position. So now again, focusing on this specific expansion right here, this downside movement, which was a 71-pip drop, so pretty solid drop to the downside. So now what I want you guys to pay attention to is formations when price moving towards one direction, and when it revisits a fair value gap, and when it leaves it empty, completely open. So what I'm talking about, after some time, when we have a drop to the downside, and let's say inside of this drop, like right here, we have a few filled fair value gaps that price revisited before dropping and continuing following the order flow right here. And inside of that one drop, we as well have some fair value gaps that were left completely untapped. So in this case, it would be this fair value gap right here. You can see that price didn't reach into it. Now, if let's say this was a wick of this candle, this would be a fair value gap that price already rejected. And now from this point, we start expecting for bearish order flow to take place. So in this case, you can see that we had another rejection and another rejection of fair value gap, price leading small pullbacks and just moving towards our point B right here. But in this case, you can see that inside of this whole movement, this fair value gap wasn't touched. So it stays as an open imbalance point. And again, now we are strictly talking about fair value gaps and imbalances. So in this case, obviously, when we start looking to the right side right here, as mentioned in some videos, often we see some fair value gaps stay as sensitive areas and stuff like that. But in this video, I'm not talking about that. What I'm talking about are specific clean points where price is likely to reach into before continue moving with the bigger pressure, with the higher time frame direction and stuff like that. So obviously, right here, we are talking only about 15 minutes. We are not going to dig into lower time frames, higher time frames, and stuff like that. We are talking strictly about this example right here. So if we take the high here and we take this low right here, let's now find equilibrium. So in this point right here, what we have is a premium. Now, on this day right here, notice that this gray box is an Asia range. We have a near midnight open right here, and price starts consolidating and starts pushing higher. So now, one thing that I want you guys to pay attention to is the fact that when price starts pulling back and they look left and look at the PD raise that we have on the left side right here, this, for example, fair value gap wouldn't be something that I would look for price to reject before dropping lower. In other words, if price right here during this day goes into this area, let's say it runs this buy side liquidity right here and starts giving confirmations to drop lower, I would be okay with the confirmations, but I wouldn't be okay being aggressive on this position, zooming into, let's say, 2 minute, 1 minute, 5 minute time frame right here. And the main reason why is because this fair value gap was already retested. And if we look higher, what we do have is some low resistance buy side liquidity signs. And what I mean by that, I think let's remember from the previous video, notice that we have this candle, this candle, this candle, and this candle. So notice how every single one of them opens and goes lower without spiking out the previous candle. So these are low resistance buy side liquidity signs. And if we look higher, what we have here is a fair value gap that wasn't touched. It's a completely empty, still valid fair value gap, not something like this or this right here. And when this happens, little resistance liquidity combined, that's just a perfect setup, perfect area to pay attention to, especially when it forms in a dealing ranges premium side, if of course you're looking for bearish continuation moves. So this is what we want to focus on. Let's now delete everything right here. So now if we extend this to the right side, notice what happens. Notice how price completely ignores everything here on the left side that happened, all the imbalance points that were already retested. Of course, as mentioned before, some areas stay sensitive areas for quite some time. So let's see this fair value gap. If we extend this, notice that we have one rejection, second rejection, third rejection right here. Then price was just consolidating around this area. And after that, it just kept on going sideways. So it stayed a sensitive area for quite some time. But again, it wasn't a catalyst point causing another reversal. So if we go higher, then again, if we look at this area, another imbalance that was already rejected, notice that price gave some reactions around this point. We are on the 15-minute time frame. So if you would drop to, let's say, 2 minutes or 5 minutes, you would see some reactions to the downside from this imbalance point. But again, it wasn't a catalyst level. It wasn't a catalyst zone to cause a complete reversal. And what price does, it climbs all the way towards this low resistance buy side liquidity here, this round formation that we just talked about, area where we have quite a lot of buy side liquidity resting, and right above what we have is this completely unfilled imbalance point, completely unfilled fair value gap. So notice that after the near midnight open, what price does, it keeps on consolidating exactly what it started right at the beginning of the dead time, which is from 3 p.m. till midnight. So we had a lot of consolidation right here. Then you can see that for the first half of the day, price kept on consolidating. And then during the New York kill zone right here, price started climbing towards the low resistance buy side liquidity deeper into the range towards the unfilled fair value gap. So when we have, let's say, this type of development, this would be the fair value gap, the imbalance to pay the most attention to, especially if you are trying to look for a more aggressive position, a more aggressive trade, when you are happy with the higher time frame and lower time frame alignment, and you're just simply waiting for a specific time of the day to give you clear signs to start shorting the market, moving towards your main draw on liquidity. So from a situation like that, what we obviously would target first would be the nearest consolidation, the nearest liquidity pool, which of course is this whole consolidation right here, and the Asia range lows, summing up the best. Because you can see that right here, we have all of this round price action right here. If you would zoom out, it would be just a sideways consolidation. So price was just simply dancing sideways. So right under, we have this massive sell side liquidity pull. So in such development, looking for where price is possibly going to run into before it gives another drop toward the sell side targets. This is how we would refine this whole area again from point A to point B. All right, so now we are again on the 15-minute time frame here on pound dollar. So another example of situations, again, we are not digging into the whole strategy and stuff like that. We are digging into the specific examples of when we have few imbalance points and you are simply not sure what to trust. So in this case, let's say we are expecting for price to reverse and keep on pushing towards the upside, towards the buy side liquidity levels. Let's imagine that we have everything set on point to expect for price to continue moving higher. So in situations like this, when we have, let's say, two imbalance points like we do have here, we have this tiny bullish fair value gap right here, and we have another fair value gap right below. In these types of situations, when we are not expecting for an institutional or the full entry drill to take place, which is just a quick tiny fair value gap rejection before price continues towards the main targets. So let me quickly explain you in a nutshell what is institutional or the full entry drill. So let's say we have a market maker by model. So we have ourselves original consolidation, price starts dropping towards the downside right here. And let's say what we have here is a key level. So key level is a key PDA, and price with this run to the downside, it runs quite a lot of sell side liquidity, let's say. What we have here is original consolidation, the main target that we'll be aiming for. So now if let's say we are on the bigger bullish delivery, on a bigger bullish vision, let's say price been on the higher timeframes and lower timeframes pushing towards the upsides. So let's say price ran the sell side liquidity here into a key PDA, which acts as a capitalist area, and price, after building the sell side of the curve, shifts into the buy side of the curve and starts building bullish delivery right here. So one thing to keep in mind is that in the first half, from this reversal right here from key PDA towards the original consolidation, which in this case would be the main area to aim for, the main drawn liquidity, measuring again from this key low towards the original consolidation, which is key target. In the first half, if you would measure and find the midpoint, in the first half, often we will see quite a lot of choppy price action, quite a lot of stop runs and stuff like that. And in the second half, what we'll often see is much clearer price action, and price starts running towards the main direction way faster. And what that usually means, that we usually don't see very deep pullbacks, we don't see a lot of stop runs, etc. Price is in a hurry to complete this model right here. Price is in a hurry to take out the main target, which is buy side liquidity right here, original consolidation that we just talked about. Let's mark original consolidation with this rectangle. So in this case, this is then usually institutional or the full entry drill type of situations happen. Price starts pulling away from the original consolidation or any other main drawn liquidity without reaching into it, of course. This is a major part. And then if we have a clear fair value gap right below, which is just a single imbalance candle, this is when price just gives this quick dip into this fair value gap and continues with the main direction right away. So usually again, it's just a simple tiny pullback for price to reach into the fair value gap and then continue towards the main target, the main drawn liquidity. So in this case, this would be institutional or the full entry drill type of a situation right here. And why we are talking about this is when we have a few imbalance points like that and we are looking at the first half of the reversal, like in this situation right here, let's say, this is when we simply wouldn't focus on the first imbalance point, because again, we are not in this type of situation and price already did all the liquidity sweeping, price already gave all the deep pullbacks and stuff like that, and it's on a run towards the main target. It's literally just on a one way almost. In those cases, we can expect for price to reach into the first fair value gap if everything's looking nice and the order flow and time of the day is on point. If when we are talking about those first stages, this is of course when we simply don't want to focus on the first imbalance point. So what we obviously do, we look lower to see what was the most recent point. So from the 15-minute time frame, so as you notice that this candle right here ran the low of this candle. So on execution time frames, you will see a pretty clear low, a pretty clear sweep of sell-side liquidity. Price starts running higher, and when it starts pulling back again, we don't know where the high is going to form. We assume when price starts pulling back, we simply assume that this is the high. Using Fibonacci tool right here, aiming from this low to the high right here, you can see that equilibrium point very nicely overlaps with this imbalance point right here. So what we simply do, we completely forget about this fair value gap. Yes, price can reject this and keep on going, but for me personally, that's only a sign that we will most likely see another deeper type of development before it actually goes. If we are, of course, 100% sure about the main low that we are trading from, and of course, the main draw on liquidity that we are pushing towards. But if we are talking strictly about about these type of developments, what I always do when I have few imbalance points, I either go to slightly higher time frame, like let's say 60 minutes, 70 minutes, when these candles completely align and become just one candle, one imbalance point. But if you don't want to do that and you want to stick to just one time frame and not hop around from one time frame to another time frame, this is when you can simply measure which one clearly aligns with the equilibrium point, and from that point we can simply expect for price to reach into and only then push away towards our main buys high liquidity levels. Using the replay tool, obviously, for example purposes, notice how price a few times tapped right into this fair value gap, completely ignoring the higher one. So we can literally just delete this one. You can get rid now of this one, and notice how this fair value gap was retested to absolute perfection and was the one that was actually holding the most weight. So that is all for this video. I hope it was helpful. I hope you learned a thing or two, and I will see you next time. Take care, guys. Have a great day.